Hey gang, welcome to Dr. Frank's Finance World. I told you that I would give you some of my favorite metrics that I look for on companies out there before I invest in them personally in my own portfolio. And basically, I will not invest in companies that don't have a positive profit margin. It's a screen you can use on FinViz very easily. But I know it means I'm going to miss some of the up and comers. I wouldn't have been in Apple early, or I wouldn't have been in Microsoft early, probably, and so forth. But ultimately, to me, there's a lot of years out there I can make money on a company. It's the ones that don't have positive earnings that get you into trouble and you have the big losses. Also, look at something called a PEG ratio. We'll talk about that in investments, but Peter Lynch talked about it in his book. If you take the price to earnings ratio and divide it by growth or scale it by growth, you'll have a multiple that should not exceed 2. So, for instance, if the price to earnings is 20 times earnings and the growth rate is 10%, 20 divided by 10 is 2. I wouldn't go any further than that. But what it allows you to do, a lot of people talk about buying low price to earnings ratio companies because that's an anomaly, something else we'll talk about in the investment part. But you know what? In the end, there's a lot of great high growth companies too. So how do you know when you're paying too much? Check out that PEG ratio. We'll talk about that more too. So I want to be in the right industry. Had a great professor named Jeff Mercer, probably still at Texas Tech University, a great researcher. And ultimately, I rely pretty heavily on a paper he wrote. There's a series of 4 of them actually, but depends on the money supply and economic data. The right industries are actually the right sectors, and there is something called sector rotation. At least I believe that's what his research shows. And it's from that that I try to decide what sectors of the economy to be into. As I'm getting ready to set up my new investments for 2023, that's some of the things I think about based on what the Fed is doing, the economy is doing, which industries I want to be in to give myself the best chance at a positive return. They talk about the right size companies. Ultimately, when you get to be ginormous, when you get to be unbelievable to me, really these days, these $1 trillion market caps, and you find market capitalization by multiplying the number of shares times the current price. But when you get these monsters out there, how do you grow an Amazon or somebody when they're already that big? I mean, they got Walmart has 1.6 million employees. How do you grow to the next level? And that's probably the problem. There is, and we'll find out, sort of a size anomaly, if you will. And there's returns associated with size firms as well that we'll find out and talk about inside the investments. I prefer firms that are somewhere between a micro cap, 400, 600 million in market capitalization, up to about 30 or 40 billion in market cap, that sort of mid cap size. I also prefer dividend payers because research shows, quite surprisingly, that growth and income is a very good combination. So ones that pay dividends but still have some growth left have done well over time. Most of you might not realize, and we'll talk about that in investments too, up until the 1970s or so, 60% of all the returns that investment people made were dividends. It wasn't actually growth in the company value. As we started to become more worldwide and there were bigger markets and so forth out there, that sort of changed. But still, the growth in income, they provide some safety, if you will, but they also have done, as far as risk and return, they are the second best among all. DCF and framing, I use that a lot. I look at the assumptions I have, and it's nice to write them down to think about what you think is going to happen next with that firm. So if it doesn't happen, why? And if I can't answer the question why, I bail out. And I don't get into firms like that. I like to buy them when they're cheap, leaning towards the 52-week low instead of the 52-week high. We'll look at that too, but that's a number that's actually given in Yahoo Finance as well. Selling close to book value. One thing that we'll look at when we get to valuation, which is one of sort of the subworlds of investing, if you will. But when we get to it, is we'll talk about firms that sell close to book value have also tended to outperform. So how do you find book value? You do the pro formas and the income statements like we talked about. We'll get a little deeper into that as well. But I like firms that are selling pretty cheap. And then, of course, watch them. I think it's going to be a fascinating series of videos, I hope for you, about the student managed investment fund process that we used at the last university I was at. We went to something called Rise. It was in Dayton, Ohio, and using the returns of our actual money for our student managed fund, we were the #1 performing student managed fund in the country. And I'm going to show you the process that we used to get there so you can determine if that might work or not for you. So on to new worlds, lots of exciting things. Have a great day. We'll see you soon. Bye-bye.